Tonight we have two really special guests here that we're really looking forward to speaking with. We have Keith Dexter, who is the CEO of Gateway Insurance Group, as well as Ryan Smith, and he's the Vice President of Commercial Insurance and a partner at Gateway Insurance Group. And this is such an important topic for everyone, whether you don't have any rental properties or you have 20. I think it's a topic that every one of us can learn something from. And I'm really looking forward to it. So I guess I will pass this off to Greg to start our evening.
Thank you very much, Amanda, and thank you, Gateway, Keith and Ryan, for joining us this evening. Really, really excited about this. In HREI, the group that we have, I would say at least once a week we get questions regarding insurance, and I think it's such an important thing, but it's often not looked at enough inside of a person's portfolio. And I think, drawing some attention, everybody seems to just be focused on, okay, I need to have insurance and I need to have a certain price that fits in my budget. But I think a greater understanding about what insurance is and the whole part that it plays in your business is really, really important. So this is long overdue for us to have experts like yourselves in to join us. So why don't we get started by maybe you guys telling us a little bit about Gateway and the history, and then we'll maybe go right into some fun questions.
Sure. So why don't I start you? I'm Keith Dexter, CEO of Gateway Insurance Group. We also own CNP Insurance Group, Canadian National Insurance Partners, which is based out of Toronto. And collectively, we're involved in well over $1 billion a year in annual premium placement. We've had tremendous growth since we started probably 11 years ago. Every year has been double-digit growth, not through acquisition, but organically. And people ask us why inside the insurance industry. People ask us why all the time, and our answer, took us a while to figure it out, is we bring a business approach to insurance. Typically, you'll have fine individual as the insurance broker, but he is just an insurance broker. That sounds depreciating, but that's not the way I intend it. We're business owners. We've built a multitude of companies. We understand how that process works. So we bring intelligent think to insurance. And Greg, you touched on it. With the way the market is going, if you go back a few years ago, insurance was just an annual expense item that you dealt with. It was pretty straightforward. Your broker showed up, you went through the renewal process. It was typically the same price as last year, a few bucks more. You need to be way out in front of that now, planning, figuring out how to journey in a way that's going to mitigate risk and bring your premiums down. So that's who I am. Ryan is, Ryan, why don't you introduce yourself?
Certainly. Thanks, Keith. Hi, everyone. I'm Ryan Smith. I'm the Vice President of Commercial Insurance here at Gateway. My history in the insurance business has been most of my career. I've spent the last 15 years working as a commercial insurance broker. I've constantly and consistently spent time insuring realty. It's a large part of my portfolio. So I continue to work in that on a daily basis, which really gives me the understanding to be able to help clients manage through these difficult times with insurance.
Awesome.
So that's just a brief. Sorry.
Go ahead. Sorry.
I was just going to say, I don't know, Greg, if you want me to just dive right into kind of the state of the union with the insurance market now.
Yeah, no, that was a great intro, and it's kind of refreshing to hear that kind of intro from from insurance side of things. But yeah, if you want to start getting into maybe giving us a little bit of a synopsis of what the state of the insurance industry and really what's happening, because all our members and investors are seeing right now is renewals and prices going up and not really understanding the state of the industry. So maybe you can give us a little insight on that. It would be great.
Certainly, happy to. So a state of the union, the insurance industry, and I'll talk kind of in the last 24-month window, which is probably when most property owners have seen a drastic increase in their insurance premiums. So I'm going to talk a little bit first about how insurance cycles work how as a business cycle it works. So there's a few types of markets. There's a hard insurance market, which is really what we're in now. That's when you're seeing higher premiums, increased underwriting scrutiny, and limited insurance companies compared to what you may have seen in the past. What drives a hard market and what's really put us into this situation? And this isn't necessarily specific to just realty. Over these past number of years, insurance as a whole has increased. I'm sure each of you, whether it be your car insurance, your tenants insurance, or your house insurance, we've all seen increases in this hard market. So the hard market cycle really does affect everyone as a whole, but there will be segments of business within certain industries that seem to get harder hit than others. What that really stems from the insurance company's perspective is loss ratios is the number one driver. So ultimately, insurance companies, how they work is they work on a dollar in, dollar out basis is really how they look at their profitability. So in a hard market, in certain situations, an insurance company can get themselves pretty quickly into a place where for every dollar in premium they're charging, they may actually be paying out $1.10 or $1.25 total expenses and claims. So when that starts to happen in the insurance market, that's when this hardening of the market starts as well. And that's what also causes insurance companies to really delve into their book of business, their own portfolios, and the individual segments that they insure and figure out what their options are. So the options for most insurance companies are, number one, how can we turn this around again and make it more profitable for us? And that's usually done through underwriting scrutiny. So we're requiring more from clients, whether it be inspections, further review. So that's kind of step one. Step two from there is looking at reducing coverages. So, in the past, maybe you had full water damage coverage on your properties, full sewer backup coverage on your properties. Now you may have noticed over the past number of years, you may be limited to, in certain situations, 25 or 50,000 for either of those coverages. Some cases you may get up to 100. But in the past, you usually would have been insured to your full policy limit for sewer backup coverage or water damage. So those are a few of the elements. And then the third and worst case scenario for insurance companies, and where it has a major impact on you as the customer, is limiting the number of insurance companies in the market. So if an insurance company's portfolio in a specific industry is performing very poorly, in a lot of cases, they will just decide, it may be temporarily, it may be permanently, that they completely pull out of an insuring segment of business, whether it be hospitality or whether it be realty, or in some cases, it actually gets more specific to, in this situation, we've seen a lot more insurers pull out specifically of residential realty. So they may be comfortable still with the strip mall or the commercial building. Things have stabilized a bit there and they haven't seen the increases that residential rental properties have seen. So that would include anything apartment buildings, duplexes, fourplexes, single family homes. Those are the areas we've seen a lot of insurance companies pull out of. So again, what that ends up looking like for you as the customer is a limited number of options with reduced coverages and higher underwriting requirements. So those are some of the things that happen in the hard market, which is kind of the state that everybody's in now. Again, it is a cyclical business, so this will cycle through over time, but I don't expect to see insurance prices ever to go back to as low as they were, 5 years ago, for example. And just to give you kind of the other side of this coin, a soft market is the exact opposite. So for every dollar an insurance company takes in, if they're paying out, for example, 90 cents on that dollar, the 90 cents includes all their expenses for all their staff and everything involved, all their overhead, and then also paying out the claim. So they're essentially making 10 cents on the dollar. When the market is like that, which it would have been 5 years ago, it's a frenzy out there of competition. Insurance companies are fighting with each other. They're competing on price. They're throwing in coverages that they usually wouldn't because they're making money and they can afford to do so. And it's all about growing the business. So that's generally what it looks like in a soft market cycle, which again, if you've been in the property business for a number of years, you've probably ridden a bit of that wave and seen the difference from where you may have been 5 years ago. So that's kind of the state of the union. That's why we're at where we're at. I'd say as of right now, we're kind of at the precipice of this increased market, the hard market. And really the only way to come out of it is to engage in your risk, be working with a broker that is educated on how to advise on the things you need to be doing to make yourself more attractive for insurance companies.
It's ultra competitive, I guess, for, you know, for us, not necessarily on the insurance side. So what happens when, for example, that happens, an insurance company decides that they're not going to cover that demographic of, or that line? Do you just get a call saying, okay, your portfolio is headed over to somebody else, or you need to find somebody else and you have a limited amount of time? What does that look like?
Yeah, that's essentially it. It's not really on a blanket basis, and it's very rare that they completely exit, because at the end of the day, an insurance company will look at, and this is where the risk management side and engagement side becomes really important. In a lot of cases, if they decide to exit a segment, it won't be everything like we're completely out of it. They'll really comb through their portfolio and find out what's the cream of the crop, who has had, you know, who have we had as a client for a number of years without any claims. So it's not always necessarily a blanket basis, but essentially we would get on an individual basis a letter of non-renewal for a client. We'd be advised usually at this point from a higher level that this is something we're going to see. So it's not a shock to us. But essentially we're advised that they're no longer writing that class of business. They typically would give us, you know, some advance notice in that situation to allow us to go find something else. So that's kind of what it looks like on our side when we start to see these changes.
Yeah. And I mean, if the landscape was to change and more, it became more competitive for underwriters, you know, we could maybe go a little bit more towards the soft market, hopefully in the future.
And that's what it's all about, right? And that's the difference that will be made is, you know, when prices do increase, it does force a bit of an engagement from the client side, as Keith alluded to earlier. In a soft market, you really don't have to pay much attention to your insurance. You renew it annually. It's just another expense item that's manageable within your parameters. But in a hard market, you know, the real difference gets made when clients start to engage, and what the ultimate impact is with client engagement into their risk is reduced claims for the insurance companies. So essentially, some of the other companies that are staying in the business, they've essentially stayed in, they've tightened up on their rules, they've increased their rates to a point where over a few years it becomes sustainable, and then it starts to return to a profitability point. When the other insurance companies who have jumped out of that business at that point start to see how it's working in the market, that it's kind of turned around, then you'll start to see some of those competitors come back in. And that's where the cyclical nature of the business really plays in. Insurance companies very rarely get completely out of a business forever. It's a very cycled thing where, you know, okay, we don't want to write residential realty right now. 3 years from now, when other companies are making money, of course, they're a business. They're going to dive back into the market and try to compete. So that's the goal. That's where everybody would like to get to, is to get to the point where there's more options out there for you, which again, you know, that affects coverage, price, everything for you as the customer.
Just to add to what Ryan's saying, and I don't know, Greg, if that picture is going to come up at all anywhere in your presentation, but the benefit to a business owner or real estate owner who is engaged in the risk is, in these difficult times, the client or the insurer looks past the risk to who the owner is, to how he manages that risk. So we call it in our industry capacity shrinks when it's tough. The key is, can you grab the capacity? And that's what we really do for our clients. Before this meeting, Ryan and I were meeting about a transportation client we have and the whole risk journey program we have and what things we're going to do. And then we're reporting back to the insurer throughout the year. This client's doing this, he's doing this, doing this, she's doing that. And get the insurer's appetite up, because they want to purge themselves of the riskier accounts. So it's important to get engaged at a time like now, or you could find yourself in the real estate sector not being able to get insurance in the next couple of years. That's a real possibility.
Wow. Yeah, I mean, up until the past 24 months, you know, it was just a tick in a box, and it was a number that you would put on your analysis spreadsheet to see if the property was, you know, worth bidding on or worth putting into your portfolio. and then it wasn't looked at again. You know, it died. You get the insurance, you put it on your property, you're covered, you put the tick in the box. But I think, you know, in the past 24 months, the investors had to look into what is actually there. And I like the term, you know, risk journey, because it's just another facet of your business that you should really understand, and probably will open your eyes to other things as well through that journey.
And all of your investors have to understand the context with which the insurers operate. And I've been known to be a little bit more blunt than some. The last thing that the insurer cares about is you, right? Like, you know, back in the day when I was in university, we went from product driven to market driven. The insurance industry is still back in product driven. This is what we have. This is what we want to sell. If you fit it, we're interested in taking a look at it. If you don't, we don't care if you go away. So it's a great advantage for you and your investors to be mindful of that and position yourself as the one they want. It's the reality. So you need to learn to play that as you move forward. That's part of that risk journey program that we have.
Great. That's excellent. That kind of leads us into talking a little bit more specifically about investors. And do you have some insight on how they can determine if they have, if they're covered enough, if they have enough insurance, or they have too much? I know one of our earlier conversations, it kind of touched on that, and it really, it still resonates with me, your response. So I'd love for you to share that with the group.
Absolutely. It's probably an area of the industry, Greg, that sees the most oversight, and there's a lot of confusion for most business owners on who picks the number that they shouldn't be insured to. Where does that number come from? Is it the price they purchased the property for? How do you really come up with a number to replace a building? So there's a few different ways you can go about that. The number one best way to make sure you are insured properly on your properties is to have a third-party replacement cost appraisal done. So as would be common in your industry, your regular market appraisal would be very similar. But the difference in a market appraisal versus a replacement cost, obviously in a market appraisal, you're looking at other factors, including the land being a major factor in that equation, versus the replacement cost sometimes could be higher or lower depending on where the property is. But that's really about that building is gone tomorrow. What is it going to cost to replace it given the current cost of construction and materials today, right? So those are the factors that you need to look at. So as I said, the number one way to do it is to have a third-party replacement cost calculation done. That's the safest way to know that you're insured properly. The second to that is if you have a contractor or a close relationship with a home builder or a contractor that builds apartment buildings or duplexes, whatever it may be, you can get an indication whether it's by a square footage basis for that particular type of property as a bit of a guideline. That's kind of something safer than just, you know, looking at a building and even with experience going, you know, I think it's probably safe to say to replace it would be $500,000, which happens most of the time. Yeah. Most owners just pick that number. It's a guess that they think, you know, that should do it. One of the biggest challenges created in the current market outside of insurance, just with regards to construction, is the building that cost $300,000 to build a few years ago is now $5 million, right? And that number in a lot of cases hasn't been equated in their insurance. There hasn't been a conversation about it. And the insurance companies haven't, you know, there's a bit of inflation on your building value each year on your policy, but that typically runs around 5%. So it's really not making up for the difference in this really quick fluctuation in pricing for contractors that we've seen. So I think the number one thing I can recommend to business owners is to pay attention to that number, look for a third-party replacement cost appraisal on them, and make sure you're having a conversation with a broker about those numbers to understand where the number came from originally. Another thing we see a lot is an owner may purchase a property from another owner. They get a copy of their insurance policy and they just pick the number that was on the previous owner's policy. And that can create a lot of challenges in this situation where you have a claim and then the insurance company comes in, they do an evaluation on a building, and where it really affects you more than anything is if you have just a partial loss. So the majority of claims, like in a fire situation, are never the entire building. It's usually only a part of the building. the insurance company has clauses built within the policy, essentially to make sure that people insure to value. If not, I've got $1 million building. I look at it, most of it's concrete. There's a bit of wood. It's probably never all going to burn. So I'll just insure it to 500,000, half of what it should be insured to. So the penalty that's within some of these policies and how it would apply, so say you've got $1 million building and you've got it insured for $500,000. The building completely burns tomorrow. Well, you've got $500,000 in coverage, and you're essentially, if you want to replace that building, you're going to be in a situation where you're kicking in the other $500,000 to build that $1 million building. So that's in a total loss situation if the building's completely gone. In a partial loss situation, so let's say you've had $100,000 worth of damage on your $1 million building that you're only insured 50% for, right? So you've insured your $1 million building for 500,000. There's been a claim for 100,000 worth of damage to part of the building. How the insurance company is going to calculate that is they're going to look at the numbers to the $1 million to replace it. They're going to say you were only 50% insured, so we're only going to give you 50% of that $100,000 loss.
Less your deductible.
Yeah, less your deductible on top of that, right? So if you've got a 2,500 or 5K deductible, you may end up with only 45 grand towards your $100,000 claim. So that's where insurance to value and understanding your replacement cost numbers become extremely important from an investment perspective.
Also, if you look at that the other way around to the original question you asked, Greg, often people are overinsured. We're dealing with a chain of real estate, I'll just call it, so I don't breach confidence. And this year, we had them do the reconstruction calculation on all their properties. And we had what, about a 60% increase in the values of their properties. Many of those properties, if they were to sell them tomorrow, might be worth 70% of what it would cost to rebuild them. So the discussion we're having with them now is, do you need to insure the full value? What would you do with that property in that situation down the road? So probably one of the greatest takeaways here that I would think most of you should grab onto if you're owning commercial real estate specifically. If you haven't had the value of your property, not market value, but reconstructed value looked at in the last 2 years, you want to do that right away. You're going to find that to rebuild that property in the HRM, for instance, has gone up anywhere from 20 to 60%. Right? So you're underinsured. And then my point to Greg's point, that might be fine. That might be where you want to be, where you start to self-insure some of your real estate, but you need to understand it. So when that bad situation happens, you're not insured at 50%, you're insured for the whole amount, and you're in a financial position to deal with whatever the results are. So you again, I'm going to jump in with this point, Ryan, because Ryan is the rock star in this industry that you're going to meet at any brokerage. Our approach is different. You're not going to get the kind of conversation you're hearing from most brokers because it's a business approach. Like, we own real estate, we own companies, we understand how this stuff evolves, how it ebbs, how it flows. We'll speak to you about the fact that insurers really don't care about you. If you go away as a customer, like if you lose one of your customers, it ruins your day. If they lose a customer, they really don't care. So that perspective and understanding all of those different elements is important. Sorry I jumped in there.
No problem. No problem.
That's great. No, it really does ring true, because a lot of us, as investors, we'll take a look at our appraisals every year. That's an exercise we do. We get it in the mail. We look at how much it's increased, and we understand that we're going to pay so much more or capped or whatever it may be on our taxes. But we don't often revisit that. That's a good point. Like, I've got to look back at my portfolio now and see what it would cost to rebuild it and make sure that, well, we're currently going through that exercise, but that's something that investors should really be aware of. I met with a builder yesterday, and he was telling me, OSB went from the craziness of $60, it dropped down to 20. And just 2 days ago, it jumped back up to $40 a square. So, you know, there's a huge ebb and flow, like you're saying, that's happening in that side. Replacement costs are jumping around all over the place, to the point where this builder said he'll probably lose, you know, 20% of the people who signed on last year to build the house because of what's happening. So yeah, building costs are up. Replacement costs are up.
So
Yeah.
if you haven't looked at that in 2 years, like I say, that's the takeaway. If you haven't really evaluated, not appraisal, not market, but what it would cost me to rebuild, it's worth the invested money. And Ryan can direct you, any of your investors, if who do we call for that, to not spend thousands and thousands, something that you should all do.
Yeah, great advice.
It is a very reasonable cost, just for anybody out there wondering in their head, you know, is this thousands of dollars? It certainly is based on the property size, right? Like it's going to cost a certain amount for, you know, a 2-unit duplex versus a 12-unit building or a 30-unit building. But typically for most, you know, smaller 4 to 12 units, you're talking a few $100, $300 or $400 to have that type of replacement cost calculation done. And then as you get, you know, more units involved, it does get a bit more expensive, but that's the scale of anything with business, right?
Yeah, let's face it, $30 to $40 is a lot cheaper than $100,000 gap in your replacement costs.
Big time. It is absolutely worth the investment, and it's worth the peace of mind. The same reason you're buying the insurance to begin with. Well, one, because your bank is sometimes forcing you to, but two, you're buying it for the peace of mind that the asset you worked so hard to evolve, to purchase, and to put into your portfolio is fully protected in the event something does go wrong.
And those type of activities, if you were to do that, you want to have your broker, and it's usually us prompting the client, but in this case, we'll just give you the advice. When you do something like that, tell your insurer, make sure your insurer finds out that you're a business type client with real estate that they want, right? That communication, well, it's like anything in life. Success comes from proactive and good communication.
Absolutely. It's no different than going to build your business case in front of a lender or a bank, right? You need to show that you know what you're doing and that they're not gonna have too high of risk.
Yeah, that's it.
With some of our investors, guys, they do invest remotely. We're seeing a lot more people investing from Ontario and other provinces. Sometimes they're buying properties and they want to improve them. Can we talk a little bit about how long a building can be vacant, you know, before it becomes an issue with an insurer?
Certainly. So one of the main kind of concepts in an insurance policy is the material risk. So essentially, when you set up an insurance policy, you provide all the information. The insurance company is basing your pricing and your rates and the contract on what they've been provided for information. So at any point, if your risk changes, whether it be vacancy, for example, or your building is under renovation, those are things that it's very important that you tell your insurance company right away. If I use the vacancy as an example, I would say 95 to 99% of policies all require you to advise your insurer within a 30-day window. So if for some reason it's vacant for longer than 30 days, you need to advise your insurer. In a situation where you haven't and it's been vacant for longer than 30 days, within your contract, the insurer would have full rights to deny a claim on that basis. And what they call that is a material change in risk. You told us we were insuring an apple, we were actually insuring an orange, right? That's kind of the basis of an insurance contract. So with vacancy, it's 30 days. With a renovation, for example, though, it's even more urgent, even more important to contact your insurance company and your broker prior to ever commencing work. Because the reality is your policy that you have is insuring a rental property with units that are occupied, not a building that is partially occupied that has construction liability attached to it. So again, if you're doing renovations, you haven't contacted your broker, something happens, the insurer again would be in a situation where they could potentially deny a claim because of that change in the risk that they didn't know about. So yeah, those are a few of probably the two top most important things to contact your insurer about and to have that conversation with the renovations prior to starting the work. And then in regards to vacancy, you really want to make sure you're having that before that 30-day window is up to avoid any coverage issues in a claim.
Hmm. It reminds me a lot of when I first started trading real estate. It's been a while, but I do remember from learning, the biggest thing they would try to drill into our heads was disclose. So disclose anything you need to disclose, and I feel like it's probably the same in insurance. People think, well, if I disclose too much, well, my rates are going to go up, but I think they don't look at the flip side. If you don't disclose it and you need it, insurance is a beast until you need it. And I think more people and smart business people need to look at it that way to mitigate the risk.
Absolutely. And my attitude generally about it is either insure it properly, provide all the information, or you're paying for something you don't know is actually going to pay you when you really need it, is what it boils down to.
Yeah. Another question we had was if you could talk a little bit about the difference between commercial and personal policies, and how we know which one we should be insured under and the pros and cons of those.
Yeah, certainly. So I'll start with talking about personal lines policies. Generally, if you have properties owned in your personal name or your spouse and yourself's personal name or just your spouse, if you have a homeowner's or a tenant's insurance package, it doesn't really matter which insurer. The majority of them will all allow you to attach up to usually 5 properties or 5 doors. So if you have a 4-unit and a 1 single family rental, then you're basically capped at that amount under a personal lines policy. One of the number one things that drives, why that makes sense is one is the cost. It sometimes can be more price beneficial if you can have it on a personal line policy versus commercial. The number one driver is if it's in your personal name, then that usually does make sense to do that. And typically when people are getting started, they'll buy their first 4 or 5 properties in their personal name, and then they grow the portfolio to the point where they decide to start a business and start rolling the future properties into the business. Some of the benefits of the personal line policy, as I mentioned, the pricing sometimes can be more competitive. There also is things, one of the major things that a personal lines policy will cover that a commercial policy in most cases will not, is pollution. So for example, you've got a 2-unit rental downtown. Some guy comes along and slits the oil line overnight and your oil line leaks. They're trying to get the copper and the oil leaks into the ground overnight. In a personal lines policy situation, the policy is going to respond to cover that type of a claim. So having that coverage under the personal lines policy is one of the major benefits to the personal lines side of it. So in some of the cons in that, personal lines is a very transactional business, right? It's very much you call in, you get a quote, someone's typing some information in a screen. There's not as much of a thought process that goes through it, where if you're dealing with a commercial broker, it's something we do every day. We're dealing with the ins and outs of insurance. We're dealing with the intricacies. So we have an educated understanding of how the business works versus just kind of entering information into a system. So that's probably one of the pitfalls of doing it under a personal line policy, is you may not get the level of expertise surrounding your industry that you may with a commercial broker. So that's just a touch. I'll let Greg, if you have any questions on that before I go into the commercial side.
No, that's good. I'm anxious to hear a little bit more on the commercial side.
Yeah, so on the commercial side, as I said, with personal lines, the number one driver usually is it in your personal name? Once you've got a property that's purchased in a business name, it's typically very difficult to have it insured under a personal lines policy. So the number one driver that pushes you in that commercial direction is, have you purchased it in a corporate or a company name, right? So that's kind of your starting point of, how do I decide where this should go? So again, for some of the pros to having the commercial policy, again, is the experience you're going to get with your broker. Depending on the size of your portfolio, obviously you get economy of scale there as well. The larger your portfolio, the more you can negotiate, get better rates with an insurer, the more competitive insurers may be with each other, depending on the volume of that portfolio. So those are a few of the major benefits, or kind of the expertise, the education you can get from a commercial broker, and then also the volume that you can utilize to kind of negotiate better deals for yourself. So those would be the benefits. some of the cons, speaking back to the pollution side of things, if I could speak to anything within the realty industry, that's the one largest exposure for all property owners that most brokers just don't educate their clients. I could never understand it. I think it's just an area where brokers are hesitant because they don't understand pollution, so they're hesitant to talk about it. But the reality is 99% of commercial policies have a 100% pollution exclusion, meaning you have that property downtown, that oil tank line gets cut overnight, you have no coverage under your current policy. And the thing that scares me for clients about that is, a building is one thing, but pollution is very different. If there is a pollution claim, the government is going to come in very quickly and they are going to force cleanup. And the one time I've seen very few multi-million-dollar building claims on the actual building themselves. I have seen plenty of pollution claims go over $1 million. So for me, and looking at clients and seeing so many out there exposed, it's an area that concerns me. One of the other reasons why, if some property owners are aware of it, pollution insurance isn't cheap, right? You may very well pay close to what you're paying for your building insurance to have your pollution insurance, but there's a reason for that, because the risk is real, the risk is there. And as I said, those are when we do see those $1 million plus claims. So for me, it's something that would keep me up at night. It's something that I think is not talked about enough with clients. And I think most clients are out there not knowing that they're not covered for this right now. And a lot of times when I have this conversation with a new client, they were completely unaware. It was never brought to their attention. So they really never understood. They just assumed, well, yes, of course I have pollution coverage.
So if you don't have an oil tank,
Yeah.
you still.
Yeah. Not necessarily. If you don't have an oil tank, you have a very minimal pollution exposure if you're not dealing with oil. But the reality is we're in Atlantic Canada here. There still is a lot of buildings running off of oil. Other things don't cause as much of an exposure. There's always some form of exposure to pollution, but it is limited compared to if you're dealing with oil. So if you take that out of the equation from a personal lines versus commercial perspective, from a coverage perspective, they're pretty much on par. But that pollution exclusion is certainly one that you need to be worried about if you do have any type of oil tanks.
So I had an experience this year with an offer on a commercial building, and the stage 1 environmental uncovered some risk, which had to bring it into a stage 2, and because there was a recycling plant nearby. Now, if that stage 2 would have been activated, the deal was terminated because the sellers just didn't want to deal with it. They didn't want to open the can of worms. And the buyers just weren't willing to take on that risk, nor did their lenders want to. But in that scenario, should they have gone through with the stage 2 environmental and they uncovered oil or something in the ground, is that something like, if that seller was covered under pollution, they would, be okay? Or, because that's this person is really stuck right now with a commercial property that's valuable that really they won't be able to sell until they mitigate this problem.
If the insurer if there was a claim and the insurer found out that they were aware a phase 2 should be done, and it wasn't done.
Yeah, possibly. So in that situation, like when a client becomes aware and doesn't deal with the problem, the insurance company in those situations they have the right to deny a claim because the client was aware, could have done something about it, and the insurance company didn't have the opportunity to step in and try to remediate or fix the problem at the right time. So in that situation, if we look back, say this was the first time the seller had identified, they had no idea that that was there. This sale has triggered the phase 1. If they had a pollution policy in place at that time, it would trigger to cover that, clean up the remediation. And this is where it goes kind of to the next step. You've got first party cleanup costs. So that's your own property, right? You've got it spilled into your ground. You have an excavator come in, they remediate that. That gets cleaned up. Where it can get much more difficult and much more expensive for remediation is whether it goes on a neighboring property. So a third party premises. So there's a few different levels of coverage you can get. You can get coverage to cover just your own property, or you can get coverage for your own property and also neighboring exposures as well. Or if you cause any damage to a third party neighboring property around you. one of the scary parts of that is, you know, if you have any streams or there could be underground water tables that potentially some pollution get into, that's when you see the multi-million dollars worth of claims. So in this situation, with that particular seller, if he had had that policy in the advance, it certainly would have been triggered as long as he wasn't aware of any prior pollution issues there.
If you're the holder of that property, that example you used, Greg, so, you know, and you've got pollution insurance, you go through a potential sale, you now know you have, it's been recommended you go to a phase 2 to get to a final sale. That doesn't mean there's anything wrong with the property, but you need to go to a phase 2. You would disclose that to the insurer at that point, right? Like you said about the real estate business, full disclosure. I'm speaking as if I'm the owner of that property. I chose not to sell it. I would tell the insurer that phase 2 is recommended to go through the process of sale. They probably won't do anything. They'll probably say fine, but I would get that documented.
Absolutely.
Right?
So if you have that pollution policy in place, you discovered, you know, you were forced to do the phase 1 or had to do the phase 1 as part of the selling agreement, and it was decided that you should go to a phase 2 or recommended that you should, that's certainly something you'd want to advise the pollution insurer. And that just goes back to that original conversation we had about material risk, right? Pollution is no different. They're insuring it, you know, as far as they know, there's no pollution there. It's discovered. It's important to share that information and make sure you're transparent with the insurance companies around it.
A good point on kind of off topic, but it's a good little colorful story. We had a client who was buying houses in the Dalhousie University area, turning them into roaming houses. So he'd have like 9 students in each house, paying however many hundreds of bucks a month, but saying that his son was the resident of the house. And then insuring with us, like getting house insurance, and he had like 9 of these. So finally, we said we put it to him, identified that his son was not living in any house, and then had a good conversation. Like he thought he was fooling the insurer. We said, well, that's great, but you know the difference when there's a claim and the insurer establishes that it is a rooming house, it is not a principal residence. They're not going to pay the claim, right? Or they have the option not to pay the. So that goes to the point. Like you can't full disclosure.
Yeah.
All the time.
And if I could speak to another quick point there, just because I think it will be beneficial to the group here, there might not be that much information or understanding out there about it. But if you do have rooming house type of properties, or even in some situations you have students renting your properties, also another very important thing to advise your insurer of. A lot of insurers, again, that's an important piece of information. The difference between, you know, you've got a house that's got 2 people, a couple living in it, versus you've got 8 different people sharing a kitchen, sharing bathrooms. There's a whole different set of liability that becomes created around that. So right now, if you're insured in a way that they expect that you have just a single family living in your single family dwelling, you've actually got 8 people. Again, there's a situation there where you may not be covered in a claim. So student rentals, or if you have any type of rooming houses, definitely want to have a conversation about that.
There's definitely a high risk, you know, especially people buying properties in central Halifax or north or south end of Halifax. If they weren't covered for rebuild costs or anything, that would be a pretty, that's what we call a career limiting decision, I guess. What are those called?
Could be very well, exactly.
Yeah. I actually witnessed one. You know, talking about pollution, I witnessed one over the past 5 years. It was a pollution. It was a small business, and somebody had came by in the middle of the night and actually cut their oil line, and it leaked out. And last I had spoke to him, the bill was up to about $700,000 in mitigation, just in clean, and they weren't done because the way oil, when a spill happens, you know, it's my biggest fear. So whenever I buy a property and it has oil, it's my first thing I do is take out the oil and put in electric heat. because they have to retest the soil. They have to, and then they have to keep digging until they get a clean sample, which, that adds up, when you have heavy machinery on site and stuff. So a lot of people, that was a personal experience where I saw it happen. And now I try to educate as many people as possible on the risks whenever they're dealing with fossil fuels on their property.
No, and that's a great point, Greg. Like ultimately, that is the best decision you can make if you have oil, if you can remove it and convert to electric or heat pumps, whatever it may be that's not oil. That's the best way to deal with that particular risk and completely get rid of
If
it.
you've ever experienced one, as I have too, the costs, the insurance, that's all one thing, but to go through it,
Yeah.
the situation I was involved wasn't mine personally, but a neighbor of mine, literally they ended up jacking the guy's house up.
Yeah.
Excavating underneath it and 2 more houses down the street, right? Like a painful process beyond all the costs, the insurance and that.
Yeah. And it can go on for quite some time, as you
It
said.
can, yeah.
Yeah, absolutely. Yeah, so sorry, we might have got off topic there from the questions. I tend to do that. I'm like a squirrel a little bit.
No problem.
Yeah, I think we covered it. I love it when we're able to we go in and we cover some of the other questions without even having to ask them. Let's talk a little bit about tenants insurance. That's one we all look at once as well. We get them in there, we make sure they have their tenant insurance, and then we don't look back. And that's something that I think about a lot, to the point where I want to know as a building owner that they continuously have tenants and insurance. And let's talk a little bit, if we can, about tenants insurance.
Certainly. So I will say to start off that the expectation from most of your insurance companies is that they require you to have your tenants to have insurance within their lease, right? So when they sign a new lease, your lease should require your tenants to get insurance. And ideally, they provide you proof when they move in. Before they move in, they provided you proof that they have that insurance. The difficult part, as most of you would probably know, it's hard to enforce it unless you're reviewing it and putting a heavy administrative burden on it annually to request copies of that. I could move into your building tomorrow, Greg. I set the policy up and I cancel it in a week, right? And you would never know the difference whether I have it or not, unless you're checking on it annually. And I think, someone could correct me if I'm wrong here, but I believe because it's not enforceable, if I move into your building, Greg, and in a year or 6 months, I cancel that policy, I don't think you have grounds to kick me out of the building because I don't have tenants insurance, right?
Mm-hmm.
So it's one of those things where it's difficult to manage. The important part of it is making sure that it's in your lease, because your insurance companies are expecting that. And I also see, and I find it's a conversation that doesn't happen often with landlords, that the broker's saying, your insurance company does expect you to have that in your lease. In a lot of cases, what happens there is you bought a building, the leases are in place, you're essentially taking over those leases, and you just kind of leave them as is. Maybe they're not renewing for a few years or something like that, so you don't have the opportunity to review that, which in those situations is normal. But again, when that lease comes up with that particular unit, you want to revise your lease, update your lease, and make sure you're including that in that section to require the tenant's insurance.
I own a bunch of investment properties. All of our leases have, as a condition of the lease moving forward, you have to provide annual confirmation of XYZ insurance. We don't know if that's legal, but we instructed our lawyers to do it, so you can hold it out in front of it that you committed to do it. If you don't, I can evict you. Not that you could, not that you would, but just having it in there, and you ask for an insurance certificate they get from the broker. The other thing, we've tried this before and it didn't work really, really well, but you recommend or you create a bit of a tenants insurance program. You got to have some critical mass number of units, but your broker is also the broker providing the tenants insurance. You control that, then you know who's got insurance.
That's a great point. And I love that point about putting it in the lease. I think I'm actually going to incorporate that into my own leases to make sure that
your lawyer might say to you, well, that's not legal, you can't afford it. Well, to help the lawyer, put it in anyway, right?
That's right.
I never said that.
We're not going to
Really,
have a lawyer on
question?
for the next 2 webinars, so.
So and where this plays an important role too, when it comes down to a claim. So say a tenant causes a fire in one of your buildings, their tenant's insurance is only going to respond to cover their stuff, right? It's going to respond to pay for their stuff. What's going to respond to pay for the damage from the fire that was caused by the tenant is your insurance policy. So that's your insurer is going to pay to fix the building. Their insurer under the tenants is going to pay for their stuff and maybe some additional living expenses. But what that creates is the ability for your insurer to then go and recoup or subrogate against those costs caused by a claim for somebody that was cooking with grease in their kitchen, for example. So it gives that ability again for your insurance company. They've just paid out 50 grand for something that was the tenant's fault. They can then go back after the tenant's insurance and recoup that 50 grand that they lost, which in turn results in a claim that wasn't paid out under your insurance. They've essentially recouped that cost.
Therefore, no price increase, because
Exactly.
you have a claim, you're gonna go up.
Exactly.
Mm.
So another important piece of that, how it kind of plays out in the long run in a claim situation. But yeah, it's not, if your tenant has insurance, for example, you might be thinking, okay, great, the tenants have insurance, they create a fire, their insurance kicks in to pay for it. It is going to be your insurance as the building owner is always going to be what kicks in to fix the building, not the tenants.
That's good to know. That's the last thing, guys, I wanted to talk about or had a quick question was with regards to deductibles. And maybe we could talk a little bit about how, because that's first, it's the last question that we get when we're setting up a policy is what would you like your deductible to be? So maybe you can explain a little bit about, can they help reduce the premium? Is there more risk?
Certainly. Yeah, I'd be happy to touch on that. So deductibles are essentially the part of the risk that you're taking on. It's the amount of money that you're going to pay first before anything beyond that amount. So I know in most cases you see 1,000, 2,500 over the past number of years. You've seen that increase. In some cases, you may see a $5,000 deductible for your water damage. Going up further from that is really a business decision. It has to make sense for you financially. You need to be comfortable with taking on that additional risk that, if I have a $5,000 claim and I've got a 5K deductible, I'm essentially insuring that myself. I've got to eat that 5,000. If I have a $10,000 claim, I'm going to pay for 5 and the insurance is going to pay for 5. So it really comes down to what you're comfortable with financially, understanding that if something goes wrong, you will be out of pocket for that amount of money. How that implies and has implications on your insurance is the higher your deductible, the more risk you take on yourself, the lower the premium. Now, from just an annual perspective, going from $5,000 to $10,000, for example, or in some cases, we're seeing a lot of business owners even going up to $25,000. It's not a significant difference on an annual basis. You may be talking to go from $5,000 to $10,000, a few $100s a year per property, right? But if you've got a schedule of 10 properties and you've done that, now we're talking something more substantial, right? You're talking a few $1,000s. If you look at your portfolio and you look at what you've paid over the last 10 years that you've had no claims, and you multiply your 2,000, now we're talking some substantial dollars. In a hard market where we're at now, it's just something that does help offset the price increases. So, you might have a 20% price increase this year. If you increase the deductible up from 5,000 to 10,000, it reduces your price down by 8%. So you're netting out a 12% increase versus your 20%. The nice thing about the deductibles is you can review that annually. You can really change them at any time other than when you've had a claim. But you can change that. So you might decide this year, I'm going to bump the threshold up and go to that 10K. And then next year prices start to come around a little bit and you find out, I'd rather just pay that couple $100 more a year this year and go back down to the $5,000 or the $2,500. So that's really how some of the deductibles can have implications on your policy. Another factor that plays into this too is, realtors, business owners have a lot of contacts. They have a lot of networks. So in a lot of cases, something from an insurance company might say, this is going to cost $8,000 to fix this. Well, maybe somebody that can do it for $4,000 or $3,000. So in those situations, you may never put that claim through anyways. So you also have to think to yourself as a business owner, what is the number that I'm never going to put through, right? Like if I have a claim for let's call it $2,000 and I've got $1,000 deductible. And this is a conversation to have with your broker. Is that worth putting through? How does that affect my future rate? What's the benefit? What's the downfall of that? So thinking about that number when you're selecting your deductibles is extremely important. And it really just comes down to, when are you going to put a claim through? What is that number for you? Or you know what, that's where I'm financially comfortable. That's my capacity. And then I really want insurance to take on any risk above that number.
We've all heard, you know, an automotive example. We're not talking about automobile insurance here, but it's a good example. We probably all know somebody who's had an accident and just paid for it themselves rather than putting it through insurance, right? And, you know, then when you have the conversation with them and it was a $3,800 repair, you say, what's your deductible? It's $1,000. And you say, what for? Right? Because you're not going to put a $1,500 claim through because it's going to double your, right? So you may as well jack up your deductible to what that point is.
Yeah.
And watch your premium come down, right?
Yeah, that's always, that's a great point. That's always how I've looked at it too, is that if I'm willing to spend that much on anything for that investment, whether it be a car or a property, then I'll set my deductible to where I'm willing to spend, and anything more, I need some help.
It goes to the capacity issue too on real estate as we move forward. As Ryan said earlier, the hard market is kind of peaking out, but not totally peaked out. But capacity is going to continue to be a big issue. So you want to reshape yourself as the client that insurer wants. We have a larger commercial real estate account who we've had for 15 years and has never had a claim. And we literally have the insurer jumping up and down to do business. They've had a gazillion claims. We won't let them put them through, right? And the last one was a pretty big claim, and we convinced them they'd pay that back in a year and a half of premium increases. And it's not a premium increase for a year and a half. It's a new base with which it's going to go up each year forever. So again, the huge telltale for us is how bad the insurer wants this client. It's wood framed without sprinklers. There's a good example for it. And they want this client.
Yeah.
Never had a claim. And between, you could discuss this stuff with your broker. It's like attorney-client privilege. If you tell me and your insurer is intact, I don't have to tell them. They never have to know. So you need a broker that you can have that, what should I do with this? Right? And take the advice of your broker.
Yeah, that's awesome. That's a good, that is fantastic, because we don't often get that. It's usually, like you said, you know, it's a phone call and this is what you need and this is what you're going to pay. So looking at it on a business sense is refreshing. That's great, guys. You answered all of the questions in one way or another without me having to ask a lot of them. So you're well adversed in the topic, obviously. I'm going to turn it there. I think you probably answered a lot of the question for our people attending the webinar, but I do see on my screen there's a raised hand here. So I'm just going to, if it's okay with you guys, I'm just going to let them ask their question directly.
Certainly.
So Brandon, the floor is yours. Welcome and thank you for joining.
You're welcome. Can you hear me?
Yeah, certainly.
I had two questions. The first one was on the pollution insurance. If you switched from, say, oil to propane or natural gas, would that still be high or worth getting for having that?
So in regards to propane, for example, propane it's more difficult to insure from a pollution perspective, because if somebody comes and cuts your propane line, it doesn't go into the ground, it just dissipates into the air. So it's not really a huge exposure. You can't quantify it if something like that happens. So it's not as much of a concern dealing with air pollutants versus something physical like oil.
Gotcha.
Yeah.
And the second one was about the tenant's insurance. If you're the landlord and that you have their tenant's insurance information, are you allowed, is the landlord allowed to contact the insurance directly instead of asking them to see if that policy is still active?
Unfortunately, no. As much as that would be a great thing, it really boils down to privacy, right? The insurance brokerage or the insurance company isn't going to be able to share that information just because of the privacy concerns around it.
Brandon, it sounds like you have your assistant with you.
Yeah, I do.
Hard work.
Start him young.
Thank you. Yeah.
Does that answer your question, Brandon?
Yes, thank you.
I think the assistant turned him off.
Yeah. I've actually had my little, I have two daughters and I've had them to properties doing landscaping and painting and vacuuming and
Nice.
cleaning. And yeah, got to start them young.
Never too young.
No,
That'll end with their 6.
yeah, that's right. Yeah, we've had enough. Where's the credit card? We're going to the mall.
Yeah.
Yeah. So let me just see if we have any other questions. We're a little bit over our timeline. I try to keep it to an hour to respect everybody's time, but Amanda or Rebecca, do we have any other questions on the forum here?
I don't believe we do. There's some conversation going on, but yeah, no, all for questions. If anyone else has a question, raise your hand. Otherwise, I think we have them all answered.
Awesome. Well, guys, I really appreciate, it's been long overdue to have somebody come and speak to our group about insurance. Maybe you can tell our group where they can learn a little bit more about you guys or get in touch with you guys if they have any questions.
Yeah, certainly. You can reach us directly at gatewayinsurance.ca is our website. Our contact information is available there. You can also find us online by calling into our direct main line. Please ask for myself. I'd be happy to have a chat with anybody that has any questions or concerns about their insurance.
Awesome. Awesome. Well, thanks again, guys. Appreciate you taking the time, and I'm sure you'll be hearing from us again.
Awesome. Thanks, Greg. We appreciate the invitation and happy to be a part of this.
My pleasure. And for everybody participating, we'll be announcing probably in the next couple of weeks what we'll be doing for April. So stay tuned. If you have any questions or concerns, you can always go through our HREI Facebook page or reach myself, Rebecca, or Amanda. We're always around to answer your questions, and we appreciate you all taking the time to join us this evening. Thank you very much and have a great night.
Thanks, Greg.
Thank you.
Good night.